there are instances when you may need to borrow money to pay an unexpected or immediate expenditure. In times of financial emergency, most people have no choice but to take out a loan. A loan normally requires you to repay the principal with interest. However, some types of loans offer cheaper interest rates than others. Among them is a home equity line of credit or HELOC, a loan option that allows you to take advantage of lower interest rates in exchange for using your home as collateral. In this video, we'll discuss what HELOC is, how it works, and how it can help you with your financing needs.
By the way, if you like this type of content, be sure to hit the like and subscribe button.
What is HELOC? A home equity line of credit or HELOC is a type of loan secured against your home's equity. A HELOC provides you with a revolving credit line that can be used for both minor and major expenses, or to consolidate debt from loans with higher interest rates, such as credit cards. Your credit line is available whenever you need them, and any unused portion will accrue no interest. Because of this, as long as you don't have any minimum withdrawal requirements at your bank, it's a great place to keep some cash on hand in case of an emergency. However, the fact that your property is being used as collateral is the biggest drawback of a HELOC. When you default on your line of credit payments, you could lose your home to foreclosure. Difference between HELOC and home equity loan. Home equity loans are often referred to as second mortgages because they function similarly to mortgages. The borrower's home equity serves as the collateral for the loan. With a home equity loan, the borrower receives a lump sum upfront. Like regular mortgages, the terms of traditional home equity loans are predetermined. Payments for principal and interest are made regularly at a specified rate. A HELOC, on the other hand, is an alternative to standard home equity loans. Similar to credit cards, HELOCs provide access to a revolving line of credit that can be used for any purpose. In contrast to home equity loans, where the funds are given to the borrower all at once, HELOCs allow borrowers to make withdrawals as needed. You can access the credit line up to its limit, make payments, and then withdraw the funds again. A HELOC's interest rate is typically variable, meaning it can rise and fall with market conditions. Some lenders, however, offer fixed rates to borrowers. How HELOCs work. HELOCs allow homeowners to tap into their home's equity to borrow money. The credit limit for a HELOC is determined by the amount of equity you have in your property. Equity can be calculated by subtracting all existing mortgages from the home's assessed market value. Most borrowers who meet the requirements can borrow up to 85% of their home's value. Suppose you have an excellent credit score and debt-to-income ratio, and the lender provides you with 85% financing of your home's value minus any existing mortgages. If you have a home worth $400,000 with a loan balance of $100,000, you would be eligible for a HELOC of up to $240,000. Generally, a HELOC involves two phases: the draw period and the repayment period. During the draw period, which is usually 10 years, you can use the line of credit in any way you like and withdraw money up to the maximum amount. You are only required to make interest payments, but you are free to make payments toward the principal as well, to help you keep future repayments manageable. After the draw period ends, all borrowed funds, plus interest at the agreed-upon rate, must be repaid over the repayment period. Most lenders provide a 20-year repayment plan. During the repayment period, you won't be able to make any further withdrawals. What is first-lien HELOC? A HELOC is essentially a second-lien mortgage that allows you to borrow money against the value of your home. However, a HELOC can also be used to pay the original mortgage. When your initial mortgage is paid off, the HELOC becomes the first lien. Let's say you have a $400,000 home and financed it through a conventional first mortgage. The $300,000 of the original loan principal has been paid off, leaving a balance of $100,000. You can take out a HELOC and use the funds to pay the remaining mortgage balance, making the HELOC your first lien. Are HELOCs better than home equity loans? Home equity loans can be useful for things like paying college tuition or making major home improvements. If you know how much you need to borrow and have a clear plan for how you intend to use the funds, a home equity loan could be your best option. On the other hand, a HELOC is preferable if you are unsure of the amount you'll need to borrow or when you'll need it. Typically, it provides you with a steady stream of funds for a specified time period. A HELOC enables you to borrow money against your credit line, pay it back in full or in part, and then borrow it again during the draw period.
We hope this animated video has helped improve your financial literacy. We do our best to provide actionable tips that are easy to digest and implement in real life. If you want to see more of these videos, please leave a like and subscribe to our channel. Also, comment what you've learned and comment what you want to learn about money in the future.
Thank you so much.
That's more than enough to help us grow and sustain our production expenses. See you in our next video.